Hello, and welcome to the February Market Update webinar. My name is Dan White, one of ARK's Associate Portfolio Managers, and I will be moderating today's call. This call was pre-recorded on Valentine's Day, February 14th. With that, I will now turn the call over to ARK's CEO and CIO, Cathie Wood. Cathie?
All right, thank you, Dan. I hope you all had a happy Valentine's Day. Yes, so as you know, I usually we start off with a little bit of a macro comment. In the Know, which I recorded on Employment Friday, so it's pretty fresh. You'll hear our comments about fiscal policy, monetary policy, economic indicators, market indicators, and I did touch a bit on something that is very important to ARK and on which our analysts and directors and our chief futurist work very hard over a number of months, and that's Big Ideas 2025. I think it's our best one yet, and you'll see why we think real GDP growth is going to accelerate given all of the productivity coming out of the 5 major innovation platforms around which we have centered our research. And you'll also see why we believe that the market, having ignored innovation for the last 4 years, except to perhaps denigrate it from time to time, is swinging our way. And these innovation platforms, robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space are going to transform the world. They are already transforming the world. So tune in to Big Ideas 2025 for some of the exciting reasons we expect the equity markets to reward these innovation platforms and the 15 different technologies underlying them during the next few years. So with that, back to you, Dan.
Thank you, Cathie. And for our listeners looking to find Big Ideas, please visit our website. There's a dedicated Big Ideas 2025 link right at the top ribbon. We will now begin the question and answer portion of today's webinar. Questions were sent from distribution partners, submitted via saytechnologies.com, and sent to our Funds X account at ARK-Funds. Cathie, I'm going to come back to you for the first question here. Fixed income continues to be of interest to advisors given the current interest rate environment. What does ARK think about the fixed income markets, and why should investors consider ARK strategies today?
Well, probably the genesis of that question is that interest rates are not falling as quickly as many investors anticipated. And the one thing that we need to emphasize is, unlike what many people think, our portfolios typically are not held hostage to interest rates. I think the shock of a 24-fold increase in interest rates in little more than a year's time really did clobber all long duration assets, including bonds. They had their worst performance since the 1700s. That was a very unusual circumstance. And even in our own history, in 2017, when the Fed was raising rates consistently, and then 2018, it continued to raise rates, those were 2 very big years for us. One was an up year, 2017. One was a down year in 2018. The market was down, but our performance was positive. So I think it's very important to disengage from this notion that interest rates hold innovation strategies hostage. That's just not true. And we do believe that interest rates have peaked. We also think that inflation, though sticky it seems, will resume its decline as the deflationary impact of these 5 innovation platforms begins to assert itself on the various inflation indicators. So what we know from the last time there were disruptive innovation platforms evolving, and multiple ones: telephone, electricity, internal combustion engine. Really, that is the last time. Interest rates were quite low, and the yield curve was inverted more than half of the time. On average, it was inverted by 100 basis points. We have that paper on our site. I think it's from 2019. So take a look at that. We're in a very similar environment. And we do think that this environment is going to be very good for our strategies.
Thank you, Cathie. Of course, very important for our investors to be thinking of their total portfolio and how innovation can fit in that, and provide diversification elements. For the next question here, I'm going to turn it over to Sam. This one was submitted from a lot of our financial advisors asking questions about just different products out there. So ER Shares private public crossover has recently joined the Destiny 100 as funds offering exposure to SpaceX. How does ARK's venture fund and its exposure to SpaceX differ from those other products?
Yeah, that's a great question, Dan. And first, I'll say we're excited because due to a recent deal closing, SpaceX remains the #1 position in the ARK Venture Fund, ARKVX. So it's a 17.5% position there. And these are all different fund structures. So ARK's Venture Fund is an interval fund. We aim to have 80% allocation to private names, so you don't need to be an accredited investor. One of the other funds is an ETF. And the reason we stayed away from something like that, or one of the limitations there, is that it can only have a 15% allocation to private names. So already you can see we've exceeded that with our interval fund. The other is a closed-end fund. And so Destiny, I believe they have, around 34% exposure to SpaceX. But because it's a closed-end fund, they are not marking it at fair value at the end of each day. So the price that you pay is not necessarily the fair market value. And this premium, it peaked at 2,000% in April. And I think, when we checked as of recording this, it was around 970%. So, we chose the interval fund because it does mark to fair market value. We think that's what's best for the end investor. But of course, you should speak to your financial advisor to fully understand the differences.
Yeah, and I think we have on our fund site, ARK-Fund site, a paper describing the differences between the Destiny structure and our interval fund structure in more detail.
And lastly, I'll say another tie back to big ideas. We do have a section on reusable rockets, which really highlights SpaceX's lead in this area and how they're continuing to drive down costs. So definitely download that and reach out with more questions if you have them.
Thank you, Sam. Cathie, I'm going to come back to you for this next one here. Elon Musk, similar to SpaceX, but is ARK worried about key man risk with Elon Musk, given his recent closeness with the new administration?
We are not. In fact, we've gotten this question practically since the beginning of the firm, because Elon, of course, is the CEO of other companies as well, or very involved with them. We believe that Elon is probably the best CEO out there from many angles, but this one in particular. We've moved into the age of AI. And as we've discussed on this webinar many times before, what is one of the most important variables for success in AI? Well, we think data, proprietary data. And you can see, given Elon's involvement in many companies, he does have access to proprietary data that no one else has access to. So that's very important. The other important thing about Elon is he attracts the best, the brightest engineers in the world. They want to work with him, and they want to work on solving the biggest problems in the world and to create massive opportunities for growth. And so Elon has been able to surround himself not only by brilliant engineers, but also a management team that is also distinctive in terms of its ability to manage a company like Tesla that has many moving parts now. It's not just about electric vehicles. It's about autonomous taxi platforms. It's about humanoid robots. So I often say Elon is the CEO who understands better than any other CEO the convergence among technologies that is taking place and creating incredible opportunities. And if you think about robotaxis and humanoid robots, that's the convergence of three of the major innovation platforms: robots, energy storage, and artificial intelligence. So with Doge, we think, as we're thinking about Elon taking on that huge new task, we listen very carefully on quarterly earnings calls. And I can tell you, the last quarterly earnings calls for the fourth quarter report, Elon was actually more engaged than I have ever heard him. So what Elon does brilliantly is he looks at pain points, and that's where he spends a lot of his time, in his companies and now in the government. But we don't think he's lost his focus at all.
Great, thank you, Cathie. Another place, Brett, I'm coming to you for this next one, and Cathie perhaps. Another place we get a lot of questions is in the genomic space and gene editing. What are ARK's most recent thoughts on CRISPR, and what are some of the dynamics at play affecting its current price?
Sure. So CRISPR Therapeutics provided a business update. CRISPR has really the first gene editing driven cure for a disease in market today and beginning to commercialize. And we think it's early in its commercialization journey. This is Casgevy, which applies to sickle cell disease and beta thalassemia. Where the company has moved, when Casgevy launched, there was some concern about whether or not insurers would be willing to pay the $2.2 million sticker price for this treatment. As it turns out, they seem to be quite willing to pay that because you avoid all of the ongoing cost of hospitalizations that severe sickle cell disease patients have. And so the net present value of all those ongoing costs plus the curing the disease, so the patient no longer has to go through chronic pain and all of the inconvenience and life-shortening effects of sickle cell disease, means that insurers are happy to pay. And now the company on the commercialization side is in the process of expanding the number of treatment centers that can offer the disease and beginning to onboard patients. Now, we've done work that suggests that a cure for a disease is worth 20 times the average medicine spent on a rare disease, and even more than two times more than even a precision therapy that totally abates the disease that you have to take regularly. And this is because when you get that the value that you're delivering to the patient up front, and so you don't have to face competitive pressures down the road for the patients that you've already treated. And we think that the market for sickle cell disease, people misunderstand how big a deal this is for patients and how many patients will take this treatment. There's roughly 60,000 patients that are eligible for this treatment at $2 million a piece. That suggests there's a $120 billion market out there that CRISPR Therapeutics will share with its partner Vertex. And we're just beginning to see the early stages of the revenue ramp, which is somewhat delayed because they have to take cells out of patients, manipulate the cells with gene editing, and then reinfuse them into patients. So even though they've signed up, they've begun cell collections on 50 patients, they haven't yet begun to recognize that revenue. And both they and Vertex have indicated their revenue is going to ramp quite significantly this year. So the market will get a better sense for what uptake will be for this treatment. From our perspective, the evidence is quite strong that if you are lucky enough to have a matched donor and you have sickle cell disease, you can get a bone marrow transplant, which is actually a more burdensome procedure and carries more health risks in our view than Casgevy. And as far as we can tell, almost every single patient that is eligible for a bone marrow transplant goes ahead and does that because severe sickle cell disease is so severe. And so we think that over reasonably small number of years, a meaningful portion of this market will commit to getting this cure done. They also just recently negotiated payer rights in England and are continuing to kind of expand the patient population that can get reimbursed. And they have a pipeline that has a lot of, because of the revenue that's going to be generated off of Casgevy, they can self-fund programs in our view. They won't have to go back to market. So the company has reached a real tipping point in terms of its trajectory. And so they are doing next generation CAR T type therapies driven by CRISPR gene editing. They have an asset that's going after type 1 diabetes. That's a gene editing asset going after type 1 diabetes, and a number of other programs that we expect to see readouts in 2025. So it's really a company that is in a tremendously interesting position, particularly given how we think Wall Street still misunderstands the cash generative nature of cures and how good a business curing disease can be, rather than a business that the misperception is, oh, if you give somebody a cure, then they're no longer somebody you can collect revenue from. But if you do the math, it's actually a great business to be in. And we think CRISPR and other gene editing companies offering cures are going to have a really remarkable half decade.
Yes, and I'm going to credit our analyst team for the incredible research, and you'll see some of it led by Brett on cures, on what cures, how AI is going to transform the healthcare industry, and what a cure it should be worth. I think the biggest surprise in speaking with analysts over these last really 10 years is, their doubt that a cure would, number one, happen in the early days, but number two, even now that it is happening. And I think the first person who was in CRISPR Therapeutics' beta thalassemia trial, he has said that before this cure, he had to go to the emergency room on average 17 times per year for a blood transfusion. And since he's taken the cure, he has not gone once. And he's been in at least 4 years. So we are talking about cures here. And yet Wall Street, or the sell side certainly, is doubtful that it's a good business model. And you'll see in Big Ideas how good of a business model we think it is, particularly now that there are roughly $300 billion of healthcare revenues, or pharma biotech revenues, that are going to fall off a patent cliff during the next 5 years. They're going to need to replenish with what we believe are going to be a proliferation of cures out there. So pretty exciting space. And I will tell you, we've faced a lot of criticism over the years for our exposure to this space. You'll see that our exposure is unlike any other healthcare indexer you'll see out there, because it is focused on how these technologies are going to transform and create companies that are going to scale enormously in the years ahead.
Thank you, Brett, and thank you, Cathie. And again, listeners, please take a look at our Big Ideas. The team does a really great job of distilling such a complex topic and putting a valuation out there on it for easier consumption. And as well, that kind of leads into this next question for Nemo. Could you please highlight your investment thesis on Tempus AI?
Yes, Dan. So Tempus AI was founded on the premise that the diagnostic and the broader healthcare ecosystem must integrate extensive data analysis powered by AI to optimize the patient care. So Tempus was established in 2015 by Eric Lefkowski, and the company was born out of his personal experience navigating inefficiencies in the healthcare system during his wife's breast cancer diagnosis. Lefkowski recognized that the lack of the large-scale data integration in healthcare led to suboptimal patient outcomes. In response, he built Tempus AI to ingest real-time healthcare data, personalized diagnostics, and significantly enhance patient care and treatment efficiency. Today, Tempus boasts a dataset over 10 times larger than the traded Guardant Health, for example, positioning itself as a leader in AI-driven diagnostics. So basically, the main point here in our investment thesis is that Tempus see that diagnostics has to go through a change. There needs to be a paradigm shift in the clinical workflow, and we need to move from the V1 diagnostics to what they call intelligent diagnostics. So what is intelligent diagnostics? So Tempus defines this approach as a six-part platform that integrates biology and AI to enhance traditional clinical workflows. The iterative nature of Tempus testing solutions ensures that as more tests are conducted, the database expanded, increasing the accuracy and effectiveness. The intelligent diagnostics workflow comprises of the following steps. So number one, there is diagnostic testing, which is conducted by Tempus. Then there's a standalone analysis of the test. The test results are initially processed as an independent output. Then those test results are integrated with other patient data, but there's something they call multimodal integration. Then the fourth step is the comparative AI analysis. So advanced algorithms compare the patient's data to similar cases with matched clinical outcomes. Then there is a generative AI insights. AI synthesizes relevant findings and presents actionable insights to a physician and a patient. And then the last step is the personalized treatment and recommendations. So the transformative potential of intelligent diagnostics extends beyond Tempus, as larger oncology diagnostics companies are also exploring AI-enhanced workflows. However, Tempus' competitive edge lies in its extensive longitudinal database and advanced AI capabilities. The ability to match a patient molecular and demographic profile to enroll in clinical trial or leverage AI-driven test results to guide our burdened oncologists represents a fundamental shift in oncology care. This innovation could significantly extend patients' life expectancy by ensuring optimal treatment selection. So basically, at the bottom line, this is a true data business. And where and this is the theme of our multi-omics, the data is we see the data as the oil in the healthcare, and the AI is the engine that is making the sense of that data and makes the application layer. And so the Tempus is really on the cutting edge in diagnostics and really revisioning what diagnostics should be and will be.
And one of the things that I have found remarkable about Tempus is it has access and is interoperating with more than half of the hospitals in the U.S. And that has been a big gating factor for data-oriented companies. Many of you may remember Athena Health, which Elliott Advisors, an activist investor, took over. And so we pulled out. But that was one of the biggest pain points, and Tempus has really done an amazing job of laying the groundwork, which could be one of the most important information health systems in the United States. And the other thing that's very interesting is we often see that a stock like Tempus, and many of the names in our multiomics and genomics portfolios, there are major inefficiencies in their coverage because healthcare and technology have never been comfortable with one another. What I mean by that, the analyst teams following them. In healthcare, they are not used to companies, and they do not like companies that move fast and break things, so to speak. And tech companies don't like the healthcare ecosystem because it's so highly regulated and bureaucratic and in many ways sclerotic, and cannot move quickly enough. Well, we think that's going to change. And I often say while the biggest revenue opportunity in the next 5 to 10 years from AI will be autonomous taxi platforms. The most profound application is in healthcare, and Tempus is one of the most important companies.
Thank you, Nemo and Cathie. And I actually have one follow-up here, too. I think it interests me, and I'm hoping it interests our listener. Nemo, late last year, we had talked about the FDA approving an algorithm of Tempus's. Can you maybe just explain in a little more detail what that is, why it's important? I find it pretty cool that the FDA is effectively approving code.
Yeah. So last year there was, I think in July or June, the FDA approved a medical device, basically the algorithm which is enabling to read out the ECG. So basically to understand how the heart is behaving. And so today this is done by the technician, and then the results are given to the doctor. And so instead of the technician doing this, the AI was doing that instead of that, and the FDA approved that AI actually can be doing this going forward. Actually recommended it. And so how I'm thinking about this, you should think this as like V0 AI agents in diagnostics. So this is even before we are talking about the AI agents. This is like a kind of AI agent which is limited, and it has a certain parameter that is kind of behaving. So it's not very, at the moment, let's say, modular and flexible, but it's basically kind of an AI agent, and it is a code, it's an algorithm that actually can read out the EKG and do that much faster and cheaper than the technicians that are doing today.
Great, thank you, Nemo. We're shifting gears here now away from the multi-omics team. This next one for both Daniel and Sam. What role does nuclear and hydrogen play in ARK's long-term energy investment thesis? And also, maybe if you can just include in big ideas, I noticed that there was a new sub-technology of distributed energy. So if you could include that in the response. Thank you.
Sure. Maybe we'll start with distributed energy. And what we're seeing there is continued cost declines. We're stationary energy storage having a big year last year. We think that's going to continue this year. And that really pairs well across multiple generation technologies. So pairs well with solar, with wind, with nuclear, really across the board. On the nuclear side is probably where a lot of the exciting change has happened, and Daniel's done tremendous research on that. So Daniel, why don't you take that away?
Sure, thanks, Sam. So yeah, as it relates to nuclear, firstly, I'd encourage everyone to look at our big ideas. There is a energy section which heavily discusses the recent developments in nuclear, alongside several blogs we've put out over the last year. But maybe where nuclear fits into all of this, Sam has done great work looking at electricity prices over time, and essentially in the United States, outside of World War II, electricity prices followed a Wright's Law cost decline curve, meaning for every cumulative doubling of megawatts, the cost of electricity was declining by a constant percentage. And this trend held until 1974, when prices have plateaued, and we believe by no coincidence this is the same year that nuclear construction costs stopped following a Wright's Law cost decline curve, having been derailed by certain regulatory changes in 1974 onwards. So when you fast forward to today, there's significant bipartisan support for nuclear energy within the US and globally. Currently, there is a craze around nuclear, particularly small modular reactors, which promise faster construction times due to their modularity, as well as streamlined regulatory paths. And this is largely sparked from AI hyperscalers who have turned to nuclear as a source of clean, firm power to support their data center build-out growth, while also committing to their net zero statements that they have made several years ago. But even aside from this craze, if you zoom out, the US has tripled or has committed to tripling nuclear capacity by 2050, and our research suggests that this will require build-outs of large reactors, small modular reactors, and also micro reactors with different end use cases. And looking at the US in particular, there's over 30 active advanced designs being built on, and we believe that a down selection from all of these designs is important to help reignite Wright's Law and iterate on those designs. And why is reigniting Wright's Law important? Well, firstly, it'll help lower electricity costs, and it'll really bring nuclear back to a cost competitive basis to other renewables like solar and wind, with a higher capacity factor, meaning that it can operate for the most part around the clock and isn't reliant on sun like solar or wind like wind turbines. So that's kind of our high-level thoughts on fission, which is creating energy by splitting atoms, and maybe just to quickly acknowledge fusion, which is the opposite, creating energy by combining atoms. And we're often asked a lot about this, and we think that there are still some technical hurdles to surpass for fusion. And even once surpassed, if fission's history is any guide to go by, it's likely that we're several years, if not a decade plus, away from a commercial fusion plant. So I know there's a lot there in nuclear. Like I said, we have a lot on our Big Ideas report alongside a couple of other blogs. But as it relates to hydrogen, Sam, I know can speak to that. So.
Yeah, I'll just speak quickly. Hydrogen, it's an existing big industry that should convert to cleaner ways of making hydrogen. But as far as, is this going to be powering passenger vehicles? I think that was a big theme that people asked about. I'm fairly confident that that has been put to bed. It's not economic relative to battery electric vehicles. You can look at the sales. I think there was 5,000 hydrogen cars sold globally. And again, at the energy storage side, there's still people saying, this could be good for long-term energy storage. With the cost declines we're seeing with batteries, I think it's becoming more and more difficult for hydrogen to compete. But that's more of an open question. If we really believe you're focusing on the future of energy, you should be paying attention to batteries, solar, wind, and nuclear.
And I'll just add one point. 50 years plus ago is when the regulation was put in place, starting, I think, US and then Japan. And if that regulation had not been put in place, according to our estimates, and correct me if I'm wrong, Daniel or Sam, electricity prices would be 10% of what they are today. But that's how important Wright's law is and the learning curve associated with new technologies.
Great. Thank you, Daniel, Sam, and Cathie. For our next question here, I'm actually going to come right back to you, Cathie. How does ARK assess geopolitical risks when investing in disruptive innovation with a global mandate?
Sure. We're certainly paying attention. That's the most important. We do not ignore it. I'll give you a good example. In 2020, as we were recovering from COVID, we noticed that China was not throwing money willy-nilly, either fiscally or from a monetary policy point of view, at the problem, and we thought that they would come out of it in a healthier way. And so, as we were diversifying our portfolios, which we do in a bull market, we leaned heavily into China with that in mind. They'd have to do less in the way of monetary tightening and so forth. By the end of 21 and end of 20 and into 21. We noticed that Xi Jinping was basically changing his spots in terms of priorities. Common prosperity was the order of the day. And he was also starting to root out some of the most talented business people from the companies we were interested in. Rooting out for whatever reason, he was saying corruption or what have you. And so we, having moved roughly 20% of the portfolio into China, started moving out and moved out increasingly as the bear market took hold. Bear market for innovation started in 2021. And so as we were concentrating our portfolios towards our higher conviction names, the Chinese stocks were exits for us. Interestingly now, we're looking at China once again through a different lens. This is the Trump-Xi Jinping axis and tariffs and so forth. And, you know, it could be that we're moving into another Nixon in China moment. Everyone trusted Nixon because he was such a hawk against communism in the day, and he opened the doors to China. I think everyone on China trusts Trump, or many investors, most investors trust Trump to do the right thing by America. So he probably has more degrees of freedom than we appreciate in terms of opening up more doors to China. So we definitely pay a lot of attention. Of course, Ukraine and the Middle East, their impact on energy prices, we certainly considered it influenced our thinking in terms of alternative sources of energy, certainly energy storage, as Daniel and Sam mentioned. Innovation solves problems, and geopolitical risks and turmoil create problems. So interestingly, during tough times, innovation actually gains traction. And so we're a portfolio full of problem solvers.
Thank you, Cathie. And of course, a lot of it can boil into, these geopolitical risks into one of our 6 scoring metrics bucket, and that's in the thesis risk category. And so this final question here, I'm going to come over to Lorenzo, a bit of a fun one. So how long before the convergence of AI and crypto becomes the new power couple of technology?
So there's different aspects to this question. Obviously, AI and AI agents have been, a hot topic. We've covered that in Big Ideas. I think number one is infrastructure in general. We are seeing the first AI agents on chain. I think if you see public blockchains for the last 7 years, a lot has been done in terms of infrastructure, right? A lot of the cryptography that we use, we have advancement in MPC with wallets, in zero knowledge technology, trusted execution environment, and all of these technologies can be and will be very useful to manage and deploy AI agents on chain. And I think that is coming to maturity. I think in terms also of throughput and efficiency, generally when you have gains in efficiency and productivity, like we see with a lot of these on-chain AI agents, you have activity rising. And for the past years, and we've covered that in Big Ideas, to transact on Ethereum or any other public blockchain, it was around 50 cents to $1, and really depends on the traffic on the network. And that is really not suitable for a lot of the automation and productivity gains for a lot of these AI agents. And so this year has really been, record breaking. We've had a lot of technical upgrades and advancement in public blockchains, where now you could transact for a cent, or even, we're potentially getting to 1 or 2 orders of magnitude less, and potentially for transacting for a hundredth of a cent. And I think that is the type of infrastructure that you need for a lot of activity. And so we're getting there, and I think it's very promising. Number 2, I would say, is around safety and security. Again, a lot of infrastructure has been improving in general, and smart contracts were unsafe, for the last 5 to 7 years, I would say. And now I think we're getting to a place where, if you look at last year, really the number of hacks, the majority of that was really social engineering and phishing. But hacks at the code level, they've been decreasing very steadily. And so even if you look at the operating system on the Ethereum virtual machine of Ethereum, you look at Solana and other public blockchains, we're doing just much better. And I think that is needed, obviously, if we look at these autonomous agents and having those tools on chain. We've also had interesting experimentation. Last year, there are two platforms, ELIZA and Virtuals, and you can think of it as AI Agents Launchpad. So it's a platform that is really easy to use for non-technical people, I would say semi-technical, to deploy AI agents. And so with a lot of the open source, AI models that we have with Facebook, even with DeepSeek and other ones, you could basically launch an AI agent with connectivity to via APIs to Telegram or Twitter. And so we're starting to see some of that experimentation, which I think is very interesting, and we'll see more of that. I think the question is like, can we see these AI agents do productive and complex tasks on chain, right? That is I think, the most interesting question. Can they be productive assets on chain? Can it be a productive assistant on chain? Can they take advantage of inefficiencies that we're not seeing? And so I think we're not there yet, but we certainly have, I think, the right infrastructure for this to happen. And even if you see, we've had the biggest acquisition ever with the Stripe acquiring Bridge, which is a stablecoin issuer that allows businesses to accept and connect basically to stablecoins. And I think that in many ways, obviously, is because stablecoins are having a great year. But I think it's also because they're aware that these AI agents will transact in traditional finance on chain, and you will need to have that connectivity. And so in many ways, I think they're preparing for the next years. So yeah, I think we're a few years away, but I think it's very promising what we're seeing so far.
And it's a great question, and Lorenzo, you just gave a great illustration of the convergence among technologies that we see taking place today, creating opportunities that people don't even realize yet. I remember when Lorenzo joined us, he had come from a background just steeped in digital assets, and he was listening to our morning meeting, and he thought, and started comparing notes with our AI team, thinking, wow, there actually could be a convergence here. And of course, that was music to our ears, because we do believe the reason we've set up ARK in the way we have. So our analysts' responsibilities are broken out not by industry or sector or sub-industry, but by technology. And we have a very collaborative analyst team because we believe these technologies are converging, and our analysts can compare notes, one helping the other both ways. It's a win-win because they understand more about their respective technologies as they understand the possibilities for convergences. So, we began thinking about the convergence between AI and digital assets or blockchain technology, perhaps is a better way of saying it, probably 5 years ago, and people didn't know what we're talking about. Now they do have a better idea, and they heard it here first.
Thank you, Cathie, and thank you, Lorenzo. I just want to say to our audience again one more time, because we're very proud of the work our research team has put into Big Ideas. Please take a look on our website, and please, if you have any feedback, pushback, any questions, tweet at us and reach out. We'd love to engage and learn from you. And so with that will conclude today's webinar. We'll briefly show performance statistics that can be found on ark-funds.com. Thank you to everyone who listened to today's call, and thank you to the entire ARK team.